I'm Jeni Brown. Welcome to MFB News. Hope everybody is very, very good. You've had a lovely week. It's been amazing weather, hasn't it? Shame it's going to be raining for bank holiday, but we're just going to gloss over that. And on the subject of bank holidays, I hope you guys all have some really nice plans. And for those of you who've got half term coming up, also hope you've got something super duper on. Now, in terms of what we're going to be covering for you this week, we are going to kick things off with our usual talk about what's been going on with swap rates and lender mortgage pricing. We're going to do something I haven't done for a while actually, and the reason I've been sort of holding off doing it is because rates have been bouncing around so much that it felt like whatever I said to you was going to be out of date within about 3 minutes. But actually I think it'd be quite useful just to do a roundup on what's been happening with lender pricing, so actually giving you some rates to kind of give you a real measure about what's going on there. We're then going to talk about a couple of pieces of lending criteria changes that have come to market in the last week, which are very, very good. And then finally, we're going to have a bit of a deep dive into rental yields. Kickstarting things this week then with swap rates and what's been going on. And it isn't the most wonderful news. So we've been talking in previous weeks about the fact that swap rates have been coming down. Why had they been coming down? Really two things: gilt rates because of the Trump tariffs. US was regarded as a less kind of safe place to put your money. Therefore, more people were thinking about the UK as a safer place to invest, and therefore we could drop our gilt rates down because we didn't have to work quite so hard to attract investors into the UK bond markets. Additionally to that, concerns about sort of the broader UK and global economy, or an economic downturn because of the tariffs. Therefore, MPC would be thinking about actually how we're going to really sort of stimulate the UK economy. Dropping interest rates down would be definitely a mechanism to help assist that. So all of these things were kind of like helping drive down swap rates, and 5-year swaps last week were at about 3.6%. But in the last week, they've started bubbling back up again. So to give you a flavour, like I mentioned 1 week ago, 5-year swaps were about 3.6. This week they're at 3.8, so they've gone up by 20 basis points, or 0.2%. Now, year on year, we're still ahead of the game because 1 year ago, 5-year swaps were literally just under 4%, so we're still doing better comparatively, but actually week on week and month on month, actually swap rates have increased. Now, the concern here, for you as borrowers, and this is the thing that you really need to be thinking about, excuse me, is actually we've seen a rush of lenders drop their pricing down in response to swap rates coming down. And when I go through the lender pricing changes in a moment, everything I'm going to be saying is downward pricing, because lenders are still kind of releasing product sets in response to that lower cost of funds. But actually, there's no escaping the fact that their cost of funds has now increased by 0.2%. So there's a very strong chance that lenders will be faced in a situation where they have no choice but to pass at least some of that back onto borrowers. So you might see mortgage rates start to kind of edge up a little bit. Now, the thing that's got me concerned about this is no matter how many times I say this, and I'm not the only person delivering this message because it's the truth, lots of people are still saying, you know what, actually, I'm going to wait and see what happens with MPC in June. Now, as we have, how I've banged on about for so long now, the MPC predicted movements are priced into the capital market. So essentially swap rates are a prediction of what's going to happen with base rates. So actually there's already a kind of very strong factoring in for a base rate reduction priced into swap rates today. So actually if swap rates didn't move from where they are today, and come June MPC decides to drop base rate down by 0.25%, it won't make much difference to fixed rates at all. So I think that's really worth keeping in mind. So for those of you who are looking at fixed rates, thinking, hang on a minute, actually I'm going to see if they come down even further, particularly because I'm expecting a base rate drop to happen in June, and actually because, I don't know, the Daily Mail tells me interest rates are going to come down as well. Actually, you might want to rethink that strategy. If you book a rate in with a lender today, 99% of lenders will let you change that rate at any time before completion, normally without any charge as well. So I would definitely encourage you to lock something in now, and if rates come down, great, you can still benefit from that. It's not that you've kind of put yourself in a position you can't get out of, but you've kind of really hedged your position. Lecture over. So in terms of swap rates, just to kind of really run through the numbers for you now. So 2-year swap rates, for those of you who are really into this stuff, as of last night, 3.79. 1 month ago, 3.69. And 1 year ago, 4.48. So like I say, year on year, much better position for both 2 and 5 year swaps, but month on month, and particularly week on week, not such good news. 5 year swaps last night, 3.8, 1 month ago, it's 3.6, and 1 year ago, just under 4%. So there you go. If you are looking to get a rate, I would run out and bag it as quickly as you can. Now, having just said all of that, we have still been seeing a run on pricing reductions in the last week, and as I mentioned, this is because lenders, if swap rates come down, lenders can't instantly, within a few moments, bring out a whole new product set. There's a whole process they have to go through. So that's why we're kind of seeing a runoff from swap rates coming down and lenders dropping pricing. So for those of you who are thinking about taking mortgages and have been considering mortgage pricing, one of the lenders you might be interested in is Landbay, who have made reductions to their HMO products for first-time landlords only, not the rest of them, by up to 0.8%, which is absolutely huge. They've also dropped some of their 2-year fixed rates, with prices now from 3.74. They've also made reductions on their product transfer rate offering and limited company trading limited company rates also. So a little wave of reductions on a fairly ad hoc basis from Landbay in the last week. If you've got an application in with Landbay, probably just worth having a look at their product set and seeing if rates have come down and you can move on to a new lower one. Now, Aldermore have also brought out some new rates in the last week. Some reductions have to their product range of up to 0.3%, but not all rates have come down. Annoyingly, I had a client who's got some mortgages going through with Aldermore. When I looked at their rates for that particular client, and nothing's actually changed, but some of their rates have come down by 0.3. So again, if you've got an application in with Aldermore, probably just worth having a look to see if you've got a new lower product you can now move on to. Foundation Home Loans have reduced some of their rates by up to 0.1%. Additionally, their short-term lending rates have gone up by 0.4%, so inversely 0.4% increase on short-term loans from Foundation. And NatWest have reduced their rates by up to 0.2%. So like I say, we're going to see the runoff of swap rates coming down, with some lenders pricing downwards. Next week's going to be interesting, so we'll be back to you then to update you more on what's been going on. So what I'm going to do now is just go through a bit of a run through on where mortgage rates are actually sitting. So I think that's quite useful because we have seen a lot of change in the last few weeks. So as usual, what I've done is take a scenario where I've got a property worth £250,000, because that's kind of fairly close to the UK average. I'm looking for a mortgage of 75% loan to value. So just to be very clear, if you were looking for a 60% loan to value rate, you could probably do better than the ones I'm going to quote. And what I'm doing is I'm looking at the cost over the 2-year fixed or 5-year fixed period or 2-year variable product to see which mortgage rates come in lowest overall. So what I'm not doing is quoting you the lowest headline rate, because the arrangement fees could be massive. What I'm not doing is quoting you a rate with no arrangement fee, because that isn't necessarily going to be this. What I'm doing is looking at the rate or the interest you're going to pay over the deal period, plus the setup fees, and giving you the lowest rate that I can see on that basis. So what I would class as in the round the most competitive deal. So let's start off with personal name borrowing first and foremost. So your 5-year fix is here, 4.27% with a 995 fee. I'm going to give you the rental calculation as well, because I think this is quite important for people to understand, because I think at the moment we're all sitting here thinking about taking mortgage rates. We're hearing that base rate's going to go down. We're hearing that fixed rates over a 2-year period should be decreasing as well. So obviously everybody's thinking, I'd like a tracker or I'd like a 2-year fixed rate. And there's absolute logic in that. I'm not saying you shouldn't be thinking about it, but the rental calculations can be a real determining factor into whether you can actually get one of these. So on that 5-year fixed rates, on that particular kind of offering, in personal names, you're looking at borrowing about 139 times monthly rent. So if your rent's £1,000 per month, irrespective of the fact the rate is available to 75% loan to value, the rental income would be capped out at 139,000 or 75% loan to value, whichever is the lower of those two. Okay, I hope that makes sense. Okay, so just to start that again, so 5-year fix is 4.27995 fee, 2 years 3.04 with a 3% fee. Rental calculation here is at about 125, so that's going to be quite low for those of you who are thinking about 2-year fixes, and discounted rates from 5.44 with no fee. Limited company options now, so 5-year fixes 5.34% with no fee. You can go up to 180 times the monthly rent here. So this is kind of like the hallelujah moment of rental calculations, because we're in a limited company and it's a 5-year fixed rate. So 180 times rent. On 2-year fixes, 5.34%. £1,500 fee, 131 times monthly rent. So you can see the real difference that taking a mortgage personally versus through a limited company, and also 2 and 5 year fixed rate starts to have on how much you can borrow per pound of rental income. Discounted rates, so variable, so linked to base rate, 5.34% with a 3% fee, and on this particular product you could have a rental calculation of 137 times the rent. So I hope that's helpful. Like I say, there's like a million other variations of these things, but actually these are the deals that I thought were kind of a good representation of what would be available in the market, looking at overall cost. Okay, now a real quickie on lender criteria rather. So Paragon have lowered their rental calculation on 5 year fixed rates for standard properties, so not HMOs and multi-units. So what they're doing is saying that they're stressing the calculation at 4.5%, which is actually really good. So the calculation would be, I'm a limited company and I'm taking a 5 year fixed rate on a 1-bedroom flat. So the rental calculation would be 125%, assuming an interest rate of 4.5%. So really, really positive. So with Paragon, you can now borrow more per pound of rental income on a 5 year fixed rate on a standard property than you could prior to the changes. The other piece of criteria we've seen this week is that Moda mortgages are now accepting day one remortgages. Now, day one remortgages are quite, for a lot of landlords who just sort of do fairly standard investing, they're just not that interesting actually. But for those people who are looking at doing refurbishments, where particularly where they're taking a bridging loan or they're injecting a bunch of their own cash into the deal, which they're going to need back, day one remortgages are quite important. So this is where you are remortgaging where you've owned the property for less than 6 months. So are Moda the only lender who offer remortgages inside of 6 months of ownership? Absolutely not. There's loads and loads of people that do it. Okay, this is not like an exceptional thing. It's great that Moda have joined the party, but it's not a they're not unique by any means. But just to run through day one remortgages. So for those lenders who will accept day one remortgages, there's some kind of pieces of criteria that can impact how they look at it and what kind of level of debt they can get to. So first of all, there are some lenders that say, we will just do a day one remortgage against market value, so what the property is actually worth rather than what you've paid for it, no questions asked. Some lenders say, we're fine to do a day one remortgage, but you have to have added value to the property if you want us to lend against a higher market value rather than what you paid for it a couple of months ago. So we're fine to accept that the property is worth more now, but you need to just demonstrate to us why. What they're really trying to avoid here is a situation where you've bought from a distressed seller. Okay, but lenders don't like that because you can imagine the kind of ethical concerns that could sit around these types of sales. So essentially, fine that you bought it for a low price, but actually, how have you made the value of the property increase? So to prove it. There are also some lenders that say, look, we don't mind doing a day one remortgage, but you have to have taken a bridging loan to buy the property. So we will not lend if you funded the purchase out of own cash. You're going to have to wait till you get to at least 6 months of ownership. There are also a bunch of lenders that say that we're happy to lend if you've owned the property for less than 6 months, but it's only going to be worth, in our eyes, what you've paid for it, irrespective of what the market value is. So it is a bit of a minefield. So if you are in the market for one of these, definitely worth giving us a call to have a chat. But actually, 2 really good pieces of lending criteria change. And as I always say, I love a bit of criteria change. So well done to Paragon and Moda. Okay, now after the slightly more miserable start with swap rates, I thought I'd end things on a high this week and just quickly touch on a report that Paragon have released with regards to rental yields. And they are reporting that buy-to-let properties are generating the highest average rental yield since February 2011, so 15 years ago. So analysis of Paragon Bank lending data has revealed that the average rental yields of 7.11% were achieved by landlords in April 2025, the highest level since February 2011, when the figures was just 1 basis point higher at 7.12. So actually that's an incredible piece of news. Following consecutive monthly increases during the first quarter of this year, the latest figure surpasses the 6.94% recorded at the end of Q4 2024, which was then a 13-year high. Paragon Bank's mortgage offer data for buy-to-let purchase and remortgages show that the latest rental income to property value ratio represents year-on-year growth of 40 basis points to 0.4%. Why is this? They go on to say that this reflects the moderation of house price inflation alongside rent increases driven by continued high levels of tenant demand and undersupply of privately rented homes. So essentially what we're saying here is that actually the rental market has been performing really, really well. We've seen very strong rental growth, as we all know. Yes, it's slowing down, but actually it's still continuing to increase because of tenant demand. But actually house prices have been very, very moderate. So actually, essentially, rental growth has driven up yields because of house prices not going absolutely gangbusters. So not bad news to hear on a dreary, rainy Wednesday morning. And that's me done for this week. As always, you know, you can give us a call if you've got any questions, 0345 345 6788. Have a gorgeous, lovely, long weekend. I hope it brightens up and it's not quite as gloomy as the weather forecasts are predicting. And I shall see you same time next week.